What's going on, guys? It's Jimmy here. We got a lot for you guys in this video. Federal Reserve Chairman Jerome Powell has some stark words about what's going to happen here for inflation and raising interest rates here, which may cost Americans more money. I'll give you that here in this video. Also, there's over 150 million Americans, which is like half of the United States, that use TikTok. And there's a lot of concerns about the data from TikTok that goes over to China. So much so that Congress, the US Congress, has banned the use of TikTok. Florida Governor Ron DeSantis has banned it for use in the Florida government and for Florida school systems. And now the state of Montana becomes the first entire US state to ban TikTok. And this would be for all regular people, just average, ordinary US citizens. Will this be happening for more states going forward as states and even lawmakers for the whole country are worried about the privacy and the security for average, everyday Americans? Take a listen here about what is happening and what could be happening for other states going forward.
Tonight, TikTok users fighting for their territory in Montana. 5 of them filing suit to block the statewide ban signed by Governor Greg Gianforte yesterday. Gianforte calling it the most decisive action of any state to protect Montanans' private data. The bill will take effect in January, and while it threatens to fine TikTok $10,000 a day for each violation of the ban and instructs app stores not to offer TikTok in Montana, enforcement details are otherwise vague.
I like being a voice for my state.
Christian Poole says he earns a modest side income as the unofficial Montana ambassador for more than 400,000 followers.
There being more cows than people here in Montana.
But he says driving out of state to use the app is not realistic.
I'm not entirely sure it'd be like super worth it taking like a possible 2-hour drive just to post.
Meanwhile, a TikTok spokesperson tells NBC News that Montanans can continue using TikTok as we continue working to defend the rights of our users. And in congressional testimony last month, its CEO insisted TikTok is not controlled by China.
The bottom line is this: American data stored on American soil by an American company, overseen by American personnel.
The ACLU, meanwhile, says there's no public evidence of harm that justifies a ban. But the ban does not mention specific national security threats and may be vulnerable, experts say, on First Amendment grounds. As Congress now weighs the possibility of a federal ban, Montana's ban creates a complicated new landscape for TikTok and the likelihood of more legal battles on the horizon. Lester?
And Jake, tell us about fallout. There's been a new Supreme Court ruling on massive social media companies.
That's right. Plaintiffs from that case had hoped to hold Twitter accountable for social media posts by users promoting terrorist ideology. But it seems that the legal protection social media companies enjoy under Section 230 remains as strong as ever.
Now, just to make this even a little bit more interesting, this does come a few days ago. A fired TikTok executive says that the Chinese government did have access to the U.S. data, and Chinese programmers had all the access to the U.S. user data. And he was fired when he made claims to this, and is now has filed a lawsuit for his unlawful firing, and says that he knows that Chinese programmers and the Chinese government had access to all U.S. user data. Yeah. The big controversy is because there's a Chinese law that says that Chinese corporations, there's a law that says that Chinese government has the right to access all users' data. They can just pillage it, and that they own it. So they can just literally take any data from it. So that's why Americans are concerned about it, because they don't want their data, literally all the data on your phone, could potentially be going to the Chinese government. Yeah. Also, Federal Reserve Chairman Jerome Powell, the guy basically in charge of raising interest rates, or at least the head guy there, just gave a speech here and gives us an idea of the direction of what's going to happen here. Take a listen.
Same college year as Ben, and I started working as a lawyer in the financial sector in the late 1970s. I recall from that time a growing sense that high inflation was essentially a permanent part of the landscape, just something that we all had to accept and deal with, and that the costs of getting rid of it were too high. So you just were getting used to it. Of course, ultimately, the Fed did step up and restore price stability, and one lesson from that era is that price stability is really the foundation of a strong economy, and that the economy doesn't work for anyone without price stability. Another is that high inflation is when we have high inflation, it is the responsibility and the obligation of the central bank to restore and sustain price stability. So today, while inflation isn't as high as it was when I was in college, it's nonetheless far above our 2% objective, and many people are currently experiencing high inflation for the first time in their lives. It's not a headline to say that they really don't like it. So we are very aware that high inflation imposes significant hardship as it reduces purchasing power, especially for those who are at the margins of the economy and living paycheck to paycheck and need to use all of their incoming income to pay for food, housing, and transportation and other essentials. And that's why the committee is so strongly committed to returning to our 2% goal. We think that failure to get inflation down would not only prolong the pain, but also increase, ultimately, the social costs of getting back to price stability, causing even greater harm to families and businesses. And we aim to avoid that by remaining steadfast in pursuit of our goals. But I want to start by saying, though, that the overall, the banks and the banking system are strong and resilient and well-positioned to deal with the challenges they may face now or in the future. So, as you pointed out, we do have separate tools: monetary policy to achieve our macroeconomic objectives, liquidity, supervisory, and regulatory tools to address financial stability issues. But I see an important distinction between separation. This is the separation principle: separation and independence. Our tools can have separate objectives, but their effects are often not entirely independent. So the tools are complementary almost all of the time because financial and macroeconomic stability are so deeply intertwined. In fact, our consensus statement notes that sustainably achieving maximum employment and price stability depends on a stable financial system. So because they're so intertwined, to me, there is not likely to be an absolute and complete separation of the tools, nor is that possible or desirable. And I think as Ben's research and the global financial crisis demonstrated, financial stability affects macroeconomic stability and vice versa. We saw that clearly at the outset of the pandemic. As a result, the tools that we use to address concerns in either arena can and will affect both, especially during extreme circumstances. That said, yes, the tools are separate, they have individual purposes, and most of the time each can be used for its intended purpose without compromising the other. For example, as you pointed out, when banking stresses emerged in early March, we used our liquidity tools, the discount window and the Bank Term Funding Program, to make liquidity available to banks that might need it. And that liquidity supported the stability of the financial system without restricting the use of our monetary policy tools to promote price stability. While the financial stability tools help to calm conditions in the banking sector, developments there, on the other hand, are contributing to tighter credit conditions and are likely to weigh on economic growth, hiring, and inflation. So as a result, our policy rate may not need to rise as much as it would have otherwise to achieve our goals. Of course, the extent of that is highly uncertain.
So, Federal Reserve Chairman says that rates may not have to rise as much as expected to curb inflation. First of all, how much did he expect they needed to rise? Right? I mean, mortgage rates have already more than doubled. They've went from under 3% to like 7%. Credit card interest rates are already the highest they have ever been. The average credit card interest rate is over 20%. The highest credit card interest rates are at 35% or higher. What did he expect them to go to? And they're possibly not even done yet. So what did he expect them to do? Did he expect credit card interest rates to be at 50%? And remember, that's an interest rate per year. That's what you pay interest every single year. Yeah. So I'll keep you up to date here. Now, this doesn't mean the interest rates are done being raised, because they could still keep doing that. I'll keep you up to date here. Let me know your thoughts here in the comments. Make sure to click the subscribe button down below and the bell icon so you don't miss out on any new videos here that come out here every day at 10 a.m., 3 p.m., and 8 p.m. Eastern Standard Time. Thanks for liking and sharing these videos. Here's some new videos you should watch next. Multiple impeachments have been filed, and there's a major change in the debt default and the negotiations going on. It's crazy here in this video. And the IRS has major warnings for millions of Americans. You can see that here in this video. So click on one of those videos next. Thanks for watching, guys, and I'll see you in the next video.